You are currently losing money not because the market is rigged, but because you are addicted to being right. Most traders believe the solution to a losing streak is more trading. They think the market owes them a recovery. This is the amateur's delusion. The professional knows that when the tape turns against you, the most aggressive, profitable, and courageous move you can make is to do absolutely nothing. In the world of Jesse Livermore, the greatest speculators weren't the ones who moved the fastest, they were the ones who knew exactly when to stand still. Imagine a man sitting in a mahogany-lined office in 1923. His name is Jesse Livermore. Outside, the ticker tape is screaming. His account is hemorrhaging. In that moment, he doesn't look for a bounce. He doesn't lower his stop-loss. He realizes that he has violated the most sacred law of the market. He has allowed his emotions to become a line item on his balance sheet. He realized that the hardest thing to protect isn't your account balance. It's your psychological capital. Once that is spent, you are truly broke, regardless of how many zeros are in your bank account. If you cannot walk away when you are losing, you aren't a trader, you're a gambler waiting for the house to turn the lights off. Let's look at the numbers, because the tape never lies. If you lose 50% of your account, you don't need a 50% gain to get back to even. You need a 100% gain just to see the surface of the water. The amateur sees a $5,000 loss and thinks, I can make that back in one good trade. The professional sees that same loss and realizes they have destroyed their ability to see the market clearly. They understand that every forced trade made in a state of revenge has a 90% probability of failure. Why? Because you are no longer trading the price, you are trading your own desperation. Consider the story of a modern trader we'll call the aggressor. He starts the week with $10,000. He takes a 2% loss on a breakout that fails. Normal. Then he takes another 2% loss trying to catch the bottom. Now he is down 4%. His ego is bruised. He decides to double his position size on the next trade to wipe the slate clean. This is the gambler's gallop. By Wednesday, his $10,000 is $6,000. He is now broke, not because he lacks funds, but because his judgment is shattered. He is digging a grave with his own mouse clicks. Livermore once said, "The big money is not in the buying and the selling, but in the sitting." This sounds simple, yet it is the hardest protocol to master. You must learn to treat your mental energy like a finite resource. Every time you stare at a chart during a losing streak, you are leaking power. The amateur thinks that by watching the flicker of the price, they can force the market to turn. The professional knows that the market moves in its own time. If you are down 10% in a week, you aren't in a slump. You are out of sync with the rhythm of the tape. Today we are going to deconstruct what I call the pivotal point of exhaustion. I will show you why your current buy-the-dip mentality is actually a slow-motion suicide. You have been taught that winners never quit, but in trading the only way to win is to know exactly when to quit for the day, the week, or even the month. By the end of this journey, you'll understand the specific protocol for rebuilding from zero, the same secret Livermore used to turn a few $1,000s into $100 million. But before you can rebuild, you must face the mirror. You must recognize the invisible stop-loss that 99% of you are currently blowing through without realizing it. Most of you focus on the dollar amount on the screen, but the real damage is happening in your mind. If you don't learn to respect this internal limit, no strategy in the world can save you. You are about to learn why waiting as a position is the most profitable trade you will ever make. But how do you identify the moment when your soul's stop-loss has been? That is the secret we will uncover in the next chapter. Most traders believe that as long as they have $1 in their brokerage account, they are still in the game. This is a lethal misunderstanding of how professional speculation works. The amateur sets a stop-loss on their screen, but they never set one on their soul. You might lose 2% of your cash on a bad trade, but you might lose 20% of your objective judgment. After a string of 5 losses, your mind is no longer a precision instrument. It is a chaotic mess of reactivity. This is the invisible stop-loss. When your mental tape starts skipping, you must close every position. If you don't, the market will eventually close you. The professional understands that trading is not a test of courage, it is a test of clarity. Jesse Livermore once remarked that there is a time for all things, but he often failed to realize it until his capital was gone. He learned that the market has seasons, just like the earth. Trying to trade a choppy, trendless market is like trying to plant corn in a blizzard. You aren't practicing or staying sharp. You are actively eroding your edge and dulling your instincts. The professional treats their attention like a finite resource more valuable than the money itself. If a trade does not behave immediately according to the tape, they do not argue, they do not hope, they exit, they understand the profound power of waiting as a position. Let's look at the boredom penalty. Imagine a trader who has been sidelined for 3 days because the market is flat. He feels productive when he is clicking buttons. He sees a minor fluctuation and convinces himself it's a pivotal point. He enters with a standard position size, and the market immediately chops him out. He loses $500. Not a disaster, right? Wrong. He has just paid a tax to the professionals. He has traded his patience for a cheap thrill. Now, when the real move finally happens, the one that could make him $5,000, he will be too hesitant or too frustrated to take it. He has hit his invisible stop loss without even realizing it. To prevent this, you must adopt the rule of 3. This is a hard protocol used by the elite to preserve their psychological capital. If you hit 3 consecutive stop losses, regardless of the dollar amount, you are legally broke for the next 48 hours. You are forbidden from touching the keys. You must shut down the monitors and walk away. This 48-hour quarantine is not a punishment, it is a reset. It forces the adrenaline to leave your system and allows your mental tape to stop looping on your failures. In Chapter 1, we spoke about the grave you dig with revenge trading. The rule of 3 is the shovel-sized barrier that keeps you from falling in. Remember, the price of admission to the next great bull move is having both the cash and the confidence to buy it. If you spend your week scalping for pennies in a sideways market, you will be too exhausted to capture the dollars when the trend ignites. The amateur is terrified of missing out on a small wiggle. The professional is terrified of being too tired to handle the big swing. You must decide today which one you are. This discipline of the clean slate is what separates the legends from the statistics. But once you have walked away and cleared your mind, how do you know when it is actually safe to return? The answer lies in the art of the clean slate, where we learn to erase the ghost of the break-even point. We will explore how to return to the tape without the baggage of your past losses in the next chapter. The market does not know what you paid for your position. It doesn't know your mortgage balance, and it certainly doesn't care about your break-even point. Yet the amateur trades as if the market has a personal memory of their bank account. When you are broke, whether financially or emotionally, your biggest enemy is your own history. You look at your P&L and see the ghost of what you used to have. This is anchoring bias, and it is the primary reason traders fail to rebuild after a crash. The professional, however, practices the protocol of the clean slate. They understand that to make $1 million, you must first be willing to trade $100 with perfect discipline. Jesse Livermore was a master of the physical reset. When the tape became a blur of red and his judgment felt heavy, he didn't sit at his desk and stare at the flickering numbers. He didn't try to grind it out. He would liquidate every single position, walk out of his office, and go to the Atlantic Ocean or the mountains. He needed to wash the tape out of his brain. He knew that a partial position is a partial attachment. If you are holding even a small hope trade, you are still tethered to your mistakes. You cannot see the next pivotal point if your eyes are fixed on the wreckage of the last one. Consider the break-even trap. Imagine a trader who lost $20,000 in a sudden market reversal. He is now obsessed with making exactly $20,000 back. A perfect setup appears, a clear breakout with high volume, but it only offers a potential $5,000 profit. The amateur passes on it, or worse, over-leverages his position size to force the $5,000 move to become $20,000. He is no longer reading the tape, he is writing a work of fiction. Because he refuses to accept the clean slate, he misses the small, consistent wins that would have rebuilt his capital and his confidence. He is trying to jump the canyon in one leap, while the professional is content to build a bridge stone by stone. The protocol of the clean slate requires a brutal honesty that most people cannot stomach. First, you must liquidate everything. If the trade isn't working right now, it isn't a trade, it's an anchor. Second, you must stop the how much and start the why. Did you lose money because of a faulty system, or because you ignored the rule of 3 we discussed in the last chapter? Finally, you must implement the 10% reset. When you return to the screens after your 48-hour quarantine, you are only permitted to trade 10% of your usual size. If you cannot trade $1,000 with discipline, you have no business trading $10,000. Sizing small isn't a sign of weakness. It is the ultimate mark of the professional. It proves that you value your process more than your ego. Most of you are trying to size up to recover losses quickly. That is the gambler's gallop, and it leads straight to the graveyard. You must learn to love the small win again. You must prove to yourself that you can follow your rules when the stakes are low, so that you don't flinch when the stakes are high. By clearing the slate, you remove the emotional debt that clouds your vision. But even with a clean slate and a small position size, how do you avoid the false starts? How do you know that the next move isn't just another trap designed to take your last few dollars? The answer is found in waiting for a specific, unmistakable signal. In the next chapter, we will define the pivotal point, the moment where the trend confirms its new direction with such force that even a child could see it. We will learn why the professional never buys the bottom, and why they are happy to pay a confirmation premium to ensure the war is truly over. The average trader spends their entire career trying to buy at the absolute bottom and sell at the exact top. They want the best price possible, believing that every cent saved on entry is a victory. This is a trap. In the professional world of Jesse Livermore, buying at the bottom is viewed as a dangerous vanity project. The amateur wants the cheapest price. The professional wants the safest price. If you are trying to catch a falling knife just to save $2 on a share price, you aren't trading, you are guessing. You must learn to love paying the confirmation premium. The confirmation premium is the small extra cost you pay to ensure the market has actually turned. It is the insurance policy that protects your capital from false dawns. Livermore never sought to be the first person in a trade. He waited for the pivotal point. This is the psychological and technical junction where the trend confirms its new direction with overwhelming force. Think of the market like a massive steam engine. It takes an incredible amount of energy to stop it and turn it around. The amateur tries to stand in front of the moving train to stop it. The professional waits for the train to come to a full halt, reverse, and pick up speed in the new direction before hopping on. Let's look at a concrete scenario. Suppose a stock has been crashing from $100 down to $60. The amateur sees $60 and thinks, it can't go any lower. He buys. The stock hits $58. He hits his stop loss. Then it hits $55, and he tries again. By the time the stock actually hits its real floor at $50, he is emotionally exhausted and financially depleted. He has violated the rule of three and ignored his invisible stop loss. Now watch the professional. He watches the stock hit $50. He watches it bounce to $54, then pull back to $52 on low volume. When it finally blasts through $56 with a massive surge in volume, that is his pivotal point. He buys at $56. Yes, he paid $6 more than the absolute bottom, but he bought with a 70% probability of success instead of a 10% hope of a reversal. The protocol for identifying a pivotal point requires two things: patience and the tape's permission. You do not decide when the market is ready. The market decides. You must wait for the price to break a previous resistance level while volume expands. This is the market singing to you. If the volume is thin, the move is a lie. If the price action is sluggish, the move is a trap. You are looking for an explosion of intent. Only then do you deploy your 10% reset position size. Remember our discussion in Chapter 3. We start small to test the water. If the market is truly at a pivotal point, it will begin to show you a profit almost immediately. Consider the lion strategy. A lion does not hunt every gazelle in the herd. It waits for the one that is perfectly positioned for a high probability kill. It will watch for hours, doing nothing. This waiting as a position is not laziness, it is the highest form of professional focus. When the lion strikes, it is with total commitment. Most of you are like stray cats, chasing every shadow and wonder why you are starving. You must wait for the market to give you a clear, undeniable invitation. However, even when you find the perfect pivotal point and enter with discipline, there is one final, seductive trap waiting to destroy your progress. It is the urge to surge, the desire to make it all back in a single moment by adding to your position at the wrong time. In our final chapter, we will master the art of rebuilding the empire. We will learn the difference between strategic pyramiding and the gambler's gallop, ensuring that once you find a winning trend, you actually have the nerve to keep it. The most dangerous moment in your trading career is not when you are losing, it is the moment you start winning again. After weeks of discipline, after honoring the rule of three and waiting for your pivotal point, you finally see a trade move in your favor. Suddenly, a surge of adrenaline hits your bloodstream. You feel the urge to surge. You want to make up for every lost dollar and every hour of waiting in a single afternoon. This is where the amateur becomes a victim of their own success. They size up too fast, they abandon their 10% reset protocol, and they turn a promising recovery into a final, crushing collapse. The professional knows that rebuilding an empire is not about the speed of the climb, but the solidity of the base. Jesse Livermore's greatest strength was never his ability to predict the future. It was his cold, calculated patience. He famously said that the big money is not made in the buying or the selling, but in the sitting, once. You have used the confirmation premium to enter a trade, and the tape proves you right. Your hardest job begins, doing absolutely nothing. The amateur is a profit snatcher. They see a $1,000 gain and close the trade immediately because they are terrified the market will take it back. The professional understands that a winning trade is a rare gift from the tape. You must protect it, but you must also let it breathe. This brings us to the protocol of pyramiding. Imagine you enter a position at the pivotal point with your small 10% test size. The stock moves up 5%. The amateur wants to take the profit. The professional, however, adds to the position. This is pyramiding, but it must only be done when you are playing with the house's money. You never, under any circumstances, add to a losing position. That is pyramiding in reverse, and it is the fastest way to the graveyard. You only increase your position size when the market has already given you a cushion of profit to absorb the risk. If your initial $1,000 trade is up $200, you might add another $500 of size. You are building a pyramid where the base, your safest entry, is the strongest part of the structure. Think of a legendary gambler at a high-stakes table. He doesn't bet the farm on every hand. He waits for the deck to be hot. When he finally gets a winning hand, he doesn't walk away after one small pot. He presses his advantage while the odds are in his favor. This is aggressive patience. You must be patient while waiting for the setup, but once the setup works, you must be aggressive in staying with it. Most of you do the exact opposite. You are patient with your losers, hoping they'll come back, and aggressive with your winners, cutting them short. To rebuild your empire, you must flip the script. As we close this loop, remember the journey we've taken. We started in the grave of overtrading. We learned to respect the invisible stop-loss. We mastered the clean slate and the 10% reset. We waited for pivotal point. Now you hold the final key. Own your process. The result of a single trade is just noise. The result of 1,000 trades followed with discipline is your destiny. Cut your losses fast. Size small until you're proven right. Wait for the turn. You are no longer a victim of the tape. You are a student of its rhythm. If you can walk away when you are broke, you have already won the greatest battle of all. But understanding the psychology is only half the war. To truly dominate the markets, you must know how to read the hidden intentions of the big money before they leave their mark on the charts. In our next series, we will dive deep into the tape-reading secrets that Livermore used to spot accumulation before the rest of the world even knew a move was coming. The empire is waiting to be built, one disciplined trade at a time. The greatest paradox of the market is that the less you care about the money, the more of it you tend to make. This sounds like heresy to the amateur, who checks their P&L every 30 seconds like a heartbeat monitor. To the professional, money is merely a way of keeping score. It is the byproduct of a perfectly executed process. If you are trading to pay your rent or to prove your worth to your family, you have already lost. You have introduced need into a space that only rewards detachment. Jesse Livermore's ultimate insight wasn't about a specific chart pattern. It was the realization that the speculator's only true job is to manage their own emotional equilibrium. When Livermore made his legendary $100 million in the crash of 1929, he didn't celebrate by counting the cash. He went home, ate a quiet dinner, and prepared for the next day's tape. He knew that the market is a continuous river. It doesn't care about your past victories any more than it cares about the grave of losses we discussed in Chapter 1. The amateur is destroyed by their peaks just as much as their valleys. They get big-headed after a win and abandon the 10% reset protocol. They think they have finally solved the market. The professional knows the market can never be solved. It can only be survived. Let's recap the journey of rebuilding. First, we identified the invisible stop-loss. This is the moment your mental clarity expires. If you've hit the rule of three consecutive losses, you must walk away. Second, we embrace the art of the clean slate. You must liquidate everything to see the tape clearly. Third, we waited for the pivotal point. We refused to buy the bottom because we were happy to pay the confirmation premium for safety. Finally, we learned the law of sitting. We realized that once the trade is right, the big money comes from doing nothing while the trend does the heavy lifting. Think of a captain of a great ship. He doesn't control the ocean, he only controls the rudder. If a storm hits, a losing streak in market terms, he doesn't scream at the waves. He secures the cargo, reduces the sails, and waits for the weather to clear. Most of you are trying to fight the storm with a rowboat and a hand-drawn map. To rebuild your empire, you must become the captain of your own discipline. You must accept that 90% of your time will be spent waiting as a position. This is the boring, unglamorous reality of the 1%. To own your process, you must commit to 4 non-negotiable pillars. Cut losses fast. A $500 loss is a lesson. A $5,000 loss is a tragedy. Size small. Your ego wants a big position, but your bank account needs a safe one. Wait for the turn. Never anticipate. Always follow the tape's confirmation. Pyramid only with profit. Never add to a loser. Ever. If you can follow these, the money will take care of itself. You are not a trader because of the car you drive or the balance in your account. You are a trader because of the silence in your mind when the market is screaming. You have learned how to step away and how to rebuild from the ashes. But there is one final skill that turns a disciplined trader into a market legend. It is the ability to read the hidden footprints of the institutions before the pivotal point even appears. In our next journey, we will unlock the secrets of accumulation and distribution. We will learn how to see the invisible hands moving the tape. The next level of your evolution starts there.